Hi there, and welcome to Rob Cuts Tax. Today I'm going to be sharing with you why I personally use borrowed funds to invest in the most tax efficient way and how it fits into my long-term plan to achieve financial independence and retire early. I've never seen anyone speak about the strategy I'm using, and with more UK workers being dragged into higher tax thresholds, this could be of interest to anyone that pays tax on their earnings. Quick disclaimer, I'm not a financial advisor. This is not financial advice. You should always seek regulated advice before acting. So today in this video I'm going to be covering the why, essentially. What are my motivations for seeking out this strategy? I'm not selling anything to you. I'm just sharing my strategy that's helped me escape higher rate tax and build a real retirement plan. I'll briefly touch on the normal methods that most UK investors utilise. I won't dwell on these too much though, as there's plenty of excellent creators out there with great guides to these tax wrappers. Finally, I'll explain the strategy that I'm using to retire early and pay far less tax in a simple, safe and legal manner. I think you'll be astonished at my case study where I expose how someone like me, earning about £60,000 a year, could be more than £17,000 better off every single year that I use this strategy. So my motivations, aside from wanting to create a comfortable retirement for myself, are also somewhat a defensive reaction to the UK's current tax environment for lower to middle earners. I want to clarify my position. I think it's good and important that we have public services that are well funded, but when you examine the data, you'll hopefully understand my position. This isn't going to be a political video or a political channel, so I'll park that there. My motivations are centred around three concerns, which are the astonishing current UK tax burden, personal tax thresholds being frozen, and what I perceive to be a state pension that seems to be slipping away from my generation. We're paying the highest tax burden since World War II, and it's still rising. When looking at the OBR's data on the chart here, it shows the UK tax burden as a share of GDP. To my amazement, it's currently higher than it was at the end of the Second World War. When you consider entire cities have been devastated by bombing and the economy was being converted from a wartime one back into a peacetime economy, it really is astonishing to see these figures. What's more, it doesn't appear that there's any light at the end of the tunnel regarding taxation on average workers. Frozen tax thresholds means that millions more people will be dragged into that 40% tax bracket without earning any more money. And here's why it looks so dire at the moment. Millions of people working average jobs are being dragged into these higher rates. What I also find concerning is the number of new taxpayers when looking at this chart here, as this may represent pensioners and others from low income households. I work in the public sector. I don't have a degree. I don't even have A levels, but 2 years ago I found myself entering the higher rate threshold. Tax thresholds have been frozen since 2021 and aren't due to change until 2031. So this is only going to get worse. The graph here shows where personal allowance should be if it had followed inflation. This is a significant erosion of my earning potential, and again, it's not due to change until 2031, so it's going to get worse. This chart shows just how much these frozen thresholds are costing workers from incomes between £20,000 and £100,000. What I notice about this is as soon as you cross that £50,000 threshold and enter into higher rate tax, it jumps dramatically. And this is something I was really feeling, and this is part of my motivation for why I went into such a radical strategy. My final area of concern relates to the state pension. Soon, it will be taxable for the first time in history. As I mentioned before, I don't have much confidence in the UK state pension. The age at when I can access it seems to be slipping further away from me. Meanwhile, life expectancy is not going up. Tax threshold freezes also mean that we will soon see pensioners with no other income paying taxes on their state pension. In combination with the aforementioned issues, the current triple lock on the UK state pension is likely to make it unaffordable for any government by the time I'm likely to arrive at the qualifying age. In summary, I'm suffering from fiscal drag due to the frozen tax thresholds, and the state pension doesn't seem like the sure thing that it used to be for previous generations. I think most people want to retire or at least reduce the amount they work before they reach state pension age. And to my mind, there are three typical routes for investors to save for an earlier retirement. The most common is a workplace pension. I have a workplace scheme and my contribution match is maxed out as I don't want to leave any free cash on the table. Salary sacrifice is still possible, but the government is looking to reduce the benefits that can be obtained from this method in the coming years. A SIPP, or self-invested personal pension, is a powerful account where I can benefit from 20% of tax relief on my contributions and claim even more back after a simple tax return online. A stocks and shares ISA is a flexible option where I can build wealth tax-free within the account. However, your money is taxed prior to it ever going in there. So these are the three normal approaches, but this isn't what I do. So now we arrive at my strategy. You're probably skeptical, and I don't blame you, but over the last 2 years I've eliminated my higher rate tax bill and quickly built a retirement portfolio that uses broad market ETFs and has what I consider to be a comfortable level of risk. As a high rate earner earlier this year, I added £15,000 of wealth to my portfolio and legally avoided £4,000 of tax. Meanwhile, I lived a normal life where I'm not afraid to enjoy my wages. So how am I doing this? Step one, I identified in about February or March of each year that would be roughly £10,000 over that 40% tax threshold. So I obtained further borrowing against my home as a small 5-year sub-mortgage. The interest rate was around 4.6% and it will cost me approximately £1,200 in interest. Step two, I use the entirety of this £10,000 loan to pay into my SIPP. Step three, I immediately qualified for 20% tax relief on this contribution. That's already more than what I will pay in interest. What's better? I submit a tax return and claim back a further 20% from HMRC, and I have no higher rate tax to pay at all. Step four, the debt is easily manageable for me and equates to around £185 a month. In 5 years' time, that debt will be gone. Step 5. That debt will be gone, but my investment will likely continue to grow until I retire in more than 20 years. If the market performs at a conservative 7% a year, it will double in value every 10 years. So how do I manage my risk? I'm strict with myself. This is not YOLO investing. It's controlled leverage. I only use fixed rate borrowing from a mortgage, and it has to be below 7% for me. I have a clear repayment plan with my mortgage provider, so I know exactly when it's going to end and I know exactly what I'm paying month on month. There's no short-term speculation. I'm not throwing this into a single stock. This money is going inside my pension and it's going into global index funds. I only borrow what I can repay comfortably. As I said before, it was around £180. That is okay for me. So let's look at a case study that's very similar to my situation in the last tax year. The interest shown is a fixed rate. I don't use variable rates because they change the maths. The basic tax relief alone often outweighs the cost of borrowing. Adding in compounding over decades and the numbers really start to make sense. On the left, you can see there's no strategy applied. So I've earned £60,270 of annual taxable earnings. So I would be due a £4,000 higher rate tax bill. I haven't invested and I haven't received any money back from HMRC. On the right, you can see where I've utilised my strategy. By utilising it, I'm paying no higher rate tax. Yes, I have just shy of £1,600 of interest to pay over 5 years, but as I've mentioned before, I can manage those costs. So due to that £10,000 contribution to the SIPP and the immediate 20% tax return, I would have £12,500 sat in that SIPP, ready to compound and grow over the years to come before I retire. After I do my tax return, I receive a further £2,500 as a tax rebate paid back by HMRC. Overall, I would be £17,400 better off using this strategy, and that's before investment growth. Sure, some of you may be looking at this and saying, well, yeah, but you're including £10,000 that you loaned. But that is my money, that is in my SIPP, so I am including it. This strategy has genuinely changed my retirement trajectory. I'm seeing the benefits already. My SIPP is ahead of schedule, and that gives me a huge peace of mind. My SIPP balance is already higher. I'm front loading those contributions, which gives me a stronger compounding base. There's more money in there early, and the interest on that, the capital growth, is going to build quicker. And as I said before, I've got a huge amount of confidence in my early retirement plan now, which gives me a huge amount of peace of mind. Firstly, I want to thank you for watching this far into my video. If you want to follow along as I optimise my SIPP, my stocks and shares ISA, and look at my overall tax strategy, please hit subscribe. I'll have a deep dive into the maths coming soon. So thank you again.